Hello, everybody. My name is Lance Uggla. I'm the chairman and CEO of IHS Markit, and it's a pleasure to be here today. The former governor of the Bank of England, Mark Carney. Mark, welcome. It's a pleasure to be with you for the next 30 minutes, and I'm looking forward to this CERAWeek conversation presented by IHS Markit. Mark, today I'd like to talk to you in this conversation, which I've really been looking forward to, about world economies, and I'm going to follow that with some questions around climate change. I know they're both areas of interest for you. And to start off with your final days as the governor of the Bank of England and the impact of the decisions you had to make to help counteract COVID-19 and the pandemic, how do you think we're doing as a set of global economies and global leaders in terms of the decisions we've made and the actions we've taken?
Well, again, thank you for having me, and thanks for what you're doing. It's funny. It was surreal in the sense of literally, I sort of nominally my last hour was supposed to be, between 11 and midnight on the Sunday night, and I was handing over to Governor Bailey. But literally that last hour, I was on the phone with the G10 equivalent central banks to execute the swap lines that were put in place. One of many, many things that were done. It was surreal, and that was the sort of tip of the iceberg of various programs that were put in place. A couple of things I'll say. One is that it was much more coordinated than, at the time there were sort of suggestions it wasn't coordinated because it wasn't a big bang announcement of everything at one time. But there was very good communication about who was going to do what and who was likely to do what when. We weren't in the situation that we were in 2008, which I also lived through, where really keeping the system together was the first priority in order to then figure out what to do about it. And so it didn't have to be nailed that way. Do I think the authorities have done enough? I certainly think they acted with real force and determination early that very much helped market functioning. Markets were able to find the price. And in terms of the financial channels, it's been very effective. And the direction of stimulus has been very effective.
Right. You mentioned briefly in your last few words here about parallels to 2008, and you were right in the middle of those as well as a decision maker. What are the key parallels? And one of the ones I'd love you to comment on is when I look back to 2008 financial crisis, China played a real role in stimulating the economy, a substantive portion of their GDP put to work. And I understand in this crisis, that amount of stimulus has been, much less. Do we have the right balance? Does that mean China still has more cards that they could play and therefore will be able to provide incremental support from here?
Yeah, a couple of things. One is that in 2008, as many people know, the financial sector itself was the problem, was the core of the problem. So part of the challenge was just actually getting stimulus through that sector. You could put liquidity into it, you could cut rates, but actually that didn't flow through to the real economy and support. So again, then fiscal was important. Of course, the central banks had to do all those things and get them right to move it forward. But the fiscal side was quite important. And you're absolutely right, Lance. The China fiscal stimulus was exceptionally important. It was exceptionally important for commodity markets. I was in Canada at the time, and the Canadian terms of trade actually improved quite substantially in 2008, which is one of the things that helped us move forward. And that was because of the big spillovers from China. China's had, they've had less policy room coming into this, both on the fiscal and on the monetary financial side. There's been a part of the challenge of success quite often is the degree of financial innovation you get on top of that, and the so-called shadow banking sector in China had grown quite substantially the last several years. They've been taking steps to manage that down, but then that meant a certain stance of policy. It's still very early days in this because we're still, for most economies, have the economy suspended effectively. It's such an unusual situation, and it's only when it's those physical controls start to come off that we will see where's supply really, how much, quote, scarring has been done to the labor market and to business, and then calibrating policy from there.
Right. How do you feel the, 2008 did a, really super job on, recapitalizing the banks and setting the banks on a new regulatory regime that's definitely made them a lot stronger. How do you feel, in this period, like the banks look, super strong, well capitalized, not a lot of articles coming out in the press that give us a lot of concern. How, if this went on for 1 or 2 years, have we put the banks in that strong a position for, that forward, a prolonged economic slowdown?
The absolute requirements of the banks went up almost 10 times in terms of their capital.
Right.
Now, so in terms of, and for UK banks, the actual capital, they were above their minimum, but when it has gone up 4 times, liquidity is up £1 trillion in the UK. For the major UK banks. So, much, much stronger position. We'd like to say that's prudence with a purpose. It's resilience with a reason. It's not there just to allow me to sleep at night or Governor Bailey or others. It's there for times like this. So one of the things that we did before I left as the Financial Policy Committee is that we loosened the capital requirements of the banks so that they could put some of those excess buffers to work, and so they'd be able to lend into the economy, and that has been taken off. It's there, and again, when you have the restart, you'd have an expectation that would be used as government starts to pull back. I mean, I don't know when that happens or how exactly they'll do it, but eventually, government pulls back. You have fewer of these guarantees. The banks have the capital. I mean, they're definitely part of the solution, but of course, the flip side, and you think about, whether it's in energy or industrial or services, is, I mean, everywhere bar tech at the moment is sitting there saying, okay, well, how am I going to invest? What's the demand outlook going to be? And you need that to actually do more than just draw down on your working capital line, right?
Right. The final one on the economy. When you look forward 5 years, deflation or inflation?
I'll have a perfect answer for that in about 5 years' time. It will all make sense, the wisdom of hindsight. Foursquare behind the stance of the central bank, Bank of England, done the right thing, absolutely. And, you make policy for the time. And you don't, one thing to remember, again, for monetary policy is that, your sweet spot as a central banker is somewhere between 18 and 24 months. Sometimes you stretch that out to about 3 years. But after a while, the stance fades away, whether it's tight or loose. And so when you get to that longer horizon, would be other structural factors plus the central bank not doing its job. So the correct answer to that question, which I will now give as a former central banker, is that if the Bank of England's inflation target is 2%, and in the medium term, shocks will, even out, and the MPC will deliver 2% inflation in the medium term.
Right. I think one of the things that I find really interesting about your time here in the UK has been your thoughts around energy and energy market transition. You've taken a real stance on that. When I look at what's happening in the world right now, I find the world starting to divide into a camp that thinks the whole concern over greenhouse gases, climate change, global warming, this is going to slow down now. And then there's another group that consider there's a real opportunity that the markets actually, and people in general, will want to accelerate the agenda. What's your thoughts on that?
Well, let's take it up one level first, which is that, and actually I literally got off a call with 50 heads of state, including most of the G7 and beyond, where some of these issues were being discussed. And when I say these issues, the phrase that gets used by some of them is, let's build back better. So what is better? What does society want? How do we, we've stopped our economies. We've had this, existential experience and this health tragedy at the same time, affecting many people personally, but society as a whole. So as you restart your economy, where do you want to go? Where do you want to go as a society? That question is being asked everywhere around the world in all the senses, right? You start with, what are the lessons from the COVID crisis? Well, one of them is you should have first job of government is protection. You got to have a resilient economy. You can't wish away systemic risks like a pandemic, and it'd be nice to wish away climate change, but you can't just put your head in the sand and pretend it's going to go away. And then what you also see is that you've got 125 and counting countries that have net zero as a legislated requirement. That's our objective, net zero by 2050. UK, Canada, EU, prominent examples, but many, many more. And so in that environment, and you're resetting your medium-term economic strategy, it's pretty likely that society, no guarantees in life, but it's pretty likely, certainly here in the UK, where it's absolutely clear that that's the orientation and the policy is set in that way. And companies, I have to say that the conversations with, not just because of my role at the UN, but the conversations with companies, particularly in the financial sector, is that they expect that orientation towards net zero. Now, I think the key thing, and if I'll take a chance, if you give me an extra minute here, just to reinforce something that I know you and I have discussed a bit in the past, which is that what's crucial here is this is a whole economy transition, right? It's every sector in the economy. That's the right way to go from where we are to get to net zero. What you don't want to do is try to jam everything into deep green activities, as worthy as they are, and divest everything else is brown and bad, and divest all those. It's different industries moving at their pace towards that transition, and it's better to start. Would have been better to start a decade ago, a little more assiduously, but you don't want to delay it. And when you sit down and fundamentally reassess your strategy as a company, which you pretty much have to do unless you're one of the tech companies in the sweet spot of this crisis. I think the question is going to be asked in a lot of jurisdictions. Okay, well, while you're doing your strategy, what's your strategy for net zero? How does that play in? And then as a provider of capital, of course, if you're a provider of capital, you're looking at, well, where's the opportunity for that? What can I fund? And what risk do I need to manage? So I think that's where it's going to land. I will say that there was not one, take it with a grain of salt, one meeting, but there was not one leader out of those 50 that didn't mention it. And normally it was a top issue. So,
well, that's good to hear. When I talk to a lot of youth, the millennials, now the Gen Zs, they really have a desire to see their generation support a cleaner world. And we saw that, in Davos this year with, the primary topic in many of the agendas included energy transition. But do you think with just these low, the real oversupply of oil, lack of economic demand, and going back a little bit to that pace of change, do you see an impact, to that pace of, the shift of the clean sources?
Absolutely extraordinary dislocations in energy markets, both on the supply and the demand side, and it is quite remarkable. First point. Second point, most people know well that these energy transitions tend to take a long time. You've got installed base, and it's marginal cost, not average cost, that's driving it. So both of those work in favor of, if the hydrocarbons will be, here for some time, without question. And that's why it's important to have a transition as opposed to flip a switch from A to B. And we spend a lot of time emphasizing that. I do think, though, that, there's a distinction between on the power generation side and the transportation side. One issue that a number of governments are facing or will face very soon is if they bailed out a heavy emitting industry like an airline, for example, as some already have done. What's the quid pro quo in terms of the speed with which that entity, when it gets relaunched, moves on a path? It's hard for an airline to be net zero, but moves on that path, although there are some exceptions, but moves on that path. So around air transport, marine transport, others, questions come up, and you see it in some of the bailout packages. I haven't seen the actual fine print, but certainly the announcements. some of the ones in Europe around fuel mandates. So, a blended renewable fuel by a certain date, a certain proportion will be there. And, that's the type of policy we may see. The stuff I do is not around that specifically. It's more about how do you just have the framework within the financial markets so banks, insurers, asset managers, asset owners have the information to make judgments around this stuff. I guess the point being that certainly the low emission vehicle versus internal combustion engine, that on the margin those economics have just changed with the petrol price, the gas price. But fuel mandates, cash, if there's cash for clunkers, it's more likely to have a green tint to it than it did in 2008, in part because the economics are there and the installed capacity is there. But these are some of the policy issues that will, and tests, to be honest, that will come out in the next, let's say, 6 months over the horizon.
Yeah, I think we're going to have a lot of, government-led programs that, are tied to policy to actually make sure the transition, happens effectively, because there's so many, factors that we're dealing with that, like you talk about EVs. I look at the pace of change, and it makes sense that needs to accelerate. But then you have gasoline prices. Yesterday, I saw them, from 108 to 115 here in the UK, and but that's still a really low number. And so, it's encouraging people with great policy that will help us make sure this energy transition keeps pace.
Yeah, I think it's right. I mean, it kind of underscores that, this is, in the jargon, is called transition risk, right? So it's where's regulation, where's it headed, and what signal does that send to the market? And one of the big questions, so as it comes into the investing consciousness, the lending consciousness, that, hey, actually we are headed towards something like net zero. I mean, it's off in the distance, but we're headed in that direction. Then you ask yourself the question for a specific industry and company and say, okay, well, what logically is going to happen in that industry? So if I'm an automaker and I sit and look at no more internal combustion engine cars in the UK, 2035, something, I'm slightly embarrassed, it might be 2030 or 2035 for France, something like that. That tells me something about where the system's going. And then the question becomes, is it possible that's going to get pulled forward, or other economic levers are going to be tweaked in that direction? Now, if you're a government, you're sitting in 2021, 2022, and you decide you want to goose your auto sector with cash for clunkers or something like that, but you also have an ICE drop dead date, that it starts to influence you. And, or at least it's a test. It's a test of whether you have a coherent policy. And then I, as an investor, or I, as a lender, start to, I look for where to anticipate it. I mean, I looked the other day, and we can debate, we don't need to debate the numbers. I just think the order of magnitude is interesting, that Tesla's worth more than Ford, GM, Fiat, Daimler, and BMW combined. So you can argue, you can cut it in half, and it's still, that shows you the delta of where the market at least thinks the growth is.
And when you've been looking at the frameworks for banks and lending portfolios, the close cousins to that, of course, the asset managers have the investors and their ESG frameworks. Have you thought a lot about the data aspects of this, where comparing apples to apples or apples to oranges? A lot of times when you're dealing with multifaceted, multi-factor type analysis, getting these analytics right will be really, really important.
Lance, you've thought more about the data aspects of this, but we do think about it, and we think about it in a couple of ways. Like, one of them is, as you know, the TCFD, and just trying to get a basic, as global as possible standard for climate-related financial disclosure, and flipping that from what is a private sector initiative, which it's got 140 trillion of balance sheet behind it now, between the asset managers, banks, etc. That needs to become put into a disclosure regulation or listing regulation or accounting standards. It needs to jump. From the private sector has done a great job. Now it's time for the public sector to bring it in. But you're asking a much broader question, and it kind of gets to the heart of ESG and the components and what drives it, and how different institutions will want to use data. And I think it's hugely important because, first off, if you look at it from the climate perspective or the transition perspective only, let's call that the E in the ESG. Well, most ESG indices, and there's over 1,000 or so last time I checked, or metrics, the S and the G dominate the E. So if you're trying to manage your portfolio for your millennial, or because you think there's value there using an ESG index, it's probably going to give you a false signal. There's some correlation there, but it's going to give you a false signal.
Mostly social and governance.
Yeah, exactly. Most social and governance, as opposed to the energy or the climate aspect. So you're an investor or a bank. Well, okay, you're going to want to drill down on the components at least there, or at least to have the option of doing that. Or if you're an index provider or other provider, and this is one of our questions we're asking of the industry, is there a better way to really hone in on transition and transition readiness of a company? My personal view is that these types of issues will just move more and more center stage. So yeah, it's interesting, what IHS's, static carbon footprint is, but where do you think it's going to go? How are you going to manage it going forward? How much is going to be of your net zero is going to be net? You're buying some offset or something versus managing down the footprint, and figuring out who's above and below the line on that is hugely important. And I'll just make one comment, and I think it was slight serendipity because before a major energy company made an announcement a few months ago of their objective to go to net zero scope 3 BP, we were pointing out this point that you want energy companies that are managing in this direction. I mean, Shell would be another example. Enel's another example. There are Iberdrola another example. And then you can make a judgment. What you don't want is an ESG or an index, in our view, for the transition, or a taxonomy that just says, oh no, energy out, all energy back. Like that doesn't get you what you need, because anybody who spends time, and your questions kind of touch on it, knows that a lot of this is about an energy transition, and surprise, surprise, you need the energy companies to be center stage for that.
Right. No, I'm a big proponent that we've got to make sure, apples are to apples and oranges to oranges. And I think for investing, I see the passive investment management, taking a big position in the asset management space. And I think for the active managers, the ESG component's going to be a real opportunity for them to be able to perform. But as an investor, you're going to need to be able to understand the measurement of that. And then, of course, if we want to make change happen in the corporate space, the frameworks you've been working on with the big banks, getting those right and measured will be really important. Maybe one final question that I think might be very relevant to many of our audience is when you're, making business and strategic decisions, you look at the US, you look at China, you look at a block, and it's so important as we think about net zero that, the G15, let's say, or the G20 is coming together, in harmony. And how do you feel we're doing? What's your scorecard on that? And as we look forward, I want to see the world leaders come together around the climate agenda, and I think we have in many places. But you're closer to that action, and what do you think the scorecard is? Or how we're doing as
Lance, a hugely important question. You put your finger on it. I mean, people recall that the run up to Paris, there was an agreement between the US and China in September, I think, of the year, and Paris was in November, which helped unlock the ambition for a bunch of other countries, because both at the time, it was quite an ambitious agreement at the time, and shifted things forward. The U.S., as you know, is is leaving the COP process the day after the U.S. election. I mean, they've given notification. So that dynamic is not there at present, and it really is a China-EU dynamic. And the question is, will there be similar levels of ambition? You know, will they spur each other on? And also, and it's not just China, that should be true for anybody, but what's win-win in terms of whether it's technology flows, whether it's capital flows. This is one of the possibilities, I think, is that some of the markets can be knit together, including carbon, offset markets, other markets there, which would provide an opportunity. Now, literally, we're recording this so in real time. The EU's released their latest variants on the Green Deal, which is more ambitious than it was coming in. Long process still to come, but some of the elements are being put in place there. You can see I want to end sort of glass half full here, because I'm going to turn a negative into a positive in that there are tensions in the relationships as there often are between large economies, large countries, but there's at the same time there's a need for places for constructive engagement, and this is a place for constructive engagement. And just step back, China, biggest producer of electric vehicles in the world, one of the biggest installed renewable bases in the world. It's run by engineers who understand this stuff. There is real potential there, and I know that in my dealings with the Chinese in the past, whether it's the PBOC or up to the Prime Minister, always on this issue, both on the energy side and the capital markets connection to it, in a very sophisticated and sort of outcome-oriented way. So that can turn. You put your finger on it. That's one of the keys to unlocking a successful COP process.
Right. And with that delayed, the COP this year being delayed, when is the next date that it'll be set for?
We don't have a date. It's postponed for obvious reasons, and it was postponed for the right reason, which is to keep the ambition high. I mean, people do things virtually now, so I guess in theory you could have had a several thousand person virtual meeting, but it was to keep the ambition high. Now, the EU-China process is still on track. I'm not directly involved in it, but there's a meeting in September, October in Leipzig, which is a key summit. And then what we're doing on the bit that I have greater visibility, which is on the private finance side, is we're putting in place kind of interim milestones so that some of these building blocks are put in place. What we're not going to do is save up stuff. We find out when COP is and we'll save it up and we'll announce when we get there. Particularly, I mean, this is the great thing about working with the private sector, is if you work with people and say, okay, we need this, and we all agree, and they work on it. Once they have it, they want to implement it. They're not going to, put it in their back pocket, which is right. So I think, we'll make some progress. But in the end, all that said, it's a negotiation. In the end, many aspects of COP are negotiation, and so you do need that deadline for the negotiation to get closed. And when we have a new date, that will mean certain things only get gripped at the end. Yeah.
Good. Thank you. I've got one personal question. Well, actually two quick ones to wrap us up here. But the last book you've read, or the pandemic book, what's the one that you're recommending?
That I'm recommending?
Yes, something that you've read in the last few months that
I read. Okay, I'm going to give
our audience to pick up.
I shouldn't say terrible answer. I give you two. It's a straight answer. Fiction, nonfiction. I read Cass Sunstein's Cost Benefit Revolution. A brilliant guy, one of the best economists, public policy, and it's very good. And actually, it turns out I didn't read it for this reason, but there's a lot in there about value statistical lives and things like that, which are relevant current thing. I'm reading the last of the Thomas Cromwell, the Light in the Mirror by Hilary Mantel, which is I may need an extension on the pandemic to get to the the lockdown to get to it. I would have thought I would have finished it by now.
Okay, great. And then finally, as a fellow Canadian, I hope you choose ice hockey over basketball, but somebody told me
Yeah.
that might
Well, first off, as between two Canadians, we don't even have to have the ice in there. It's hockey, and I was happy for the Raptors and all that sort of stuff, but I would rather watch hockey all the time.
Thanks, Mark. It's been a real pleasure speaking with you today. I've really enjoyed it. I hope you've enjoyed it as well. Next year, let's try to do this in person. And until then, be safe, you and your family, friends, and colleagues. I wish you all well. Thank you for joining the CERAWeek Conversations presented by IHS Markit.
Well, my pleasure.